Yeah, welcome to my channel. In this video we are going to be looking at value added tax, which is VAT. VAT is a consumption tax and it is levied or imposed on the value added to goods and services at each stage of production or distribution. So this kind of tax is charged at every stage of production or distribution based on the value that is added to the goods or services. And this tax is paid by the final consumer, and businesses act as intermediaries as they collect the VAT from the final consumer and they remit it to the Uganda Revenue Authority. So businesses collect VAT from customers and send it to URA. For example, if a factory makes bread and sells it to a supermarket at UGX 5000, including VAT, then the supermarket sells the bread to the customer at 7000 UGX, including VAT. So the supermarket only pays VAT on that extra 2000 it added to the price. So 18% of that 2000 is the VAT they are supposed to pay. Value added tax was introduced in Uganda on 1st July 1996 and it was replacing the previous sales tax system. Initially, VAT was set at a single rate of 17%, which was aimed at simplifying tax collection and expanding the base. However, its introduction faced several challenges, including resistance from traders as many businesses opposed the new tax due to the increased tax burdens and higher costs. Then there was compliance issues. Some businesses underreported sales or failed to register for VAT. There's also technical difficulties. The tax authorities experienced problems with computer systems used for VAT administration. So to improve efficiency and acceptancy, the government made adjustments over time, such as increasing the VAT registration threshold to reduce the tax burden on small businesses, then also reducing the number of zero-rated items to limit VAT refunds and boost revenue collection, then also raising the VAT rate to 18% from 17%, which remains in effect today. So currently the VAT rate is 18%. The key features of VAT. So we have three of them. The first one is the multi-stage tax. So VAT is applied at every stage of the supply chain, from production to the final sale. For example, if a farmer sells wheat to a miller, they charge VAT. Then the miller processes the wheat into flour and they sell it to a bakery, then they charge VAT again. Then the bakery uses the flour to make bread and they sell it to a supermarket, they again charge VAT. Then the supermarket sells the bread to the final consumer and they also charge VAT. So it applies at every stage of the supply chain, from production to the final sale. So another key feature of VAT is that it is based on the value added. So each business is taxed only on the value added to the product or services, not the full price. So it is only the additional value a business creates, not the full price. If a furniture maker buys wood of UGX 500,000, including VAT, after making a table, they sell it at UGX 1 million. So the VAT is not charged on the entire 1 million, but only on the extra value added, which is 1 million minus the 500,000. So the value added was for 500,000. The 18% is on that 500,000. So it is only on the value added, not on the entire price. What we have is a credit system. So businesses can always claim back the VAT paid on their purchases, which is input VAT, against what they charge on their sales, which is output VAT. So before paying VAT, we always have to subtract the output VAT minus the input VAT. Then the balance is what is supposed to be paid. For example, if a restaurant buys ingredients of 200,000, including VAT of 36,000, then it sells it at 500,000, including VAT of 90,000. So the input VAT is 36,000, then the output VAT is 90,000. So for us to get the VAT that is supposed to be paid to URA, we get the output VAT minus the input VAT. So we get 90,000 minus the 36,000, which was the input VAT. So output minus input VAT, the difference of 54,000 is what is paid to URA. So businesses can claim back their input VAT. So those are the three key features of VAT. It's a multi-stage tax and it is based on value added, then also the credit system. Let's look at how VAT works. We have input VAT, output VAT, then net VAT payable. So input VAT, this is the VAT a business pays on its purchases. Then output VAT, it's VAT a business charges on the sale of goods or services. So input VAT is the VAT a business pays when they're purchasing goods or services. For example, if a bakery buys flour for UGX 1M, including VAT of 180,000. So 180,000 is the input VAT. Yeah. Then the output VAT, this is the VAT a business charges when selling goods or services. For example, if a bakery uses flour to make bread and sells it at 2M UGX, charging 360,000 VAT to customers. So that 360,000 is the output VAT. So the net payable VAT is the amount the business pays to the tax authority, which is URA, after deducting the input VAT from the output VAT. That is the net VAT payable. So net VAT is output VAT minus input VAT. So if output VAT is greater than the input VAT, then the business pays the difference to the tax authority. And if input VAT is greater than output VAT, the business will claim for a refund from URA. Yeah, so for example, if output VAT is 360 and then input VAT is 180, the difference between 360 and 180 will be the net VAT payable to URA, which is 180. Yeah, and if it's the other way around, then the business will have to claim for that difference from URA. So if the input VAT is greater than the output VAT, then the business will claim for refund, yeah, from the tax authority. VAT in Uganda, the standard rate of VAT in Uganda is 18%. Previously it was 17%, but now it is 18%. So we have the VAT exempt goods or services. So some goods and services do not attract VAT, meaning businesses dealing in them cannot charge VAT or claim VAT input refunds. Yeah, so certain goods and services, for example, financial services, EG, bank loans, insurance, education services, EG tuition fees at school and universities, medical services, EG hospital treatment, unprocessed agricultural products like maize, raw coffee beans, they are exempt from VAT, they don't attract VAT. Then we have the zero rated goods or services. So these are goods and services that attract VAT but at 0%. So they attract VAT at 0%, and businesses can claim for refund on the input VAT for those supplies. So here businesses can claim for refund on zero rated, but on exempt, businesses can't claim for refund. That is the difference. So these ones do not attract VAT. These ones attract VAT at 0% and they can claim for refund. And examples of the zero-rated goods or services, we have exports, we have medicines manufactured in Uganda, we have educational materials, etc. Then the registration threshold for VAT, businesses in Uganda must register for VAT if their annual taxable turnover exceeds 150 million. So a company that earns below 150 million is not supposed to register for VAT. Yeah, so if a trader selling clothes makes UGX 120 million a year, then VAT is not required, or they are not supposed to register for VAT. Then filing and payment. Businesses must file VAT returns every month with the Uganda Revenue Authority, and payments are due by the 15th day of the following month. Yeah, so if a company collects 500,000 VAT in March, it must file that VAT return and pay this amount by April 15th. Let's look at the advantages of VAT. First is that it encourages transparency and compliance in the tax system. So since VAT is collected at every stage of the supply chain, businesses must maintain proper records to claim tax credits. So this reduces tax evasion and ensures that all businesses pay their fair share. Yeah. Then it allows businesses to reclaim VAT on purchases, reducing tax burdens. So businesses can reclaim VAT on their purchases, which is input VAT, which reduces their overall tax liability. Then it generates significant revenue for the government. VAT is a major source of government income for funding infrastructure, healthcare, and then education. Challenges of VAT. The first one is the administrative complexity, especially for small businesses. So small businesses struggle with VAT registration, record keeping, and filing monthly tax returns. Then we have another challenge of cascading effects in supply chain if input VAT is not properly claimed. So if a business fails to claim input VAT, it increases costs and leads to higher consumer prices. Then another challenge we have is compliance and enforcement issues like underreporting or fraud. Some businesses underreport sales or issue fake invoices to reduce VAT payments. So let's look at the exempt goods and services. We said exempt goods and services, they do not attract VAT at all, and then businesses cannot claim input VAT. Yeah, and the exempt goods and services we have in Uganda, we have unprocessed foodstuffs like fresh fruits, vegetables, and grains. We have educational services like tuition fees for schools and universities. We have medical, dental, and nursing services. We have financial services, e.g. banking and insurance. Passenger transportation services, excluding tour and travel operators. Petroleum fuel, e.g. petrol, diesel, paraffin. Then we have social welfare services, burial and cremation services, unimproved land, and certain leases of immovable property. We have veterinary equipment and supplies, and then we have machinery for agriculture and dairy processing. Then we have the zero-rated goods and services. So zero-rated, these ones attract VAT at a rate of 0%. And they allow businesses to claim their input VAT. So examples of these ones include exports of goods and services, so goods that are delivered outside Uganda, then drugs and medicines manufactured in Uganda, educational materials, e.g. textbooks and stationery. We have seeds, fertilizers, pesticides and hose. We have cereals grown, mailed or produced in Uganda. We have international transport services, goods or passengers transported across borders. Yeah, so those are the zero rated goods and services, and that is all about VAT. Yeah, so in the next video we are going to be having a full example on how to calculate for value added tax, an example from Uganda. Yeah, thanks for watching. Do not forget to subscribe, like, comment, share with your friends. Let's catch up in my next video.